Hi, my name is Garth McKenzie. I'm a technical analyst and an ETF strategist with traderscorner.co.za. I'm taking a look at the S&P 500 today again and taking a look at some of the key metrics in what is turning out to be a very strong market rally. It's a rally that surprised many market participants, myself included. And it does seem as if that market is now pushed up to the upside. The S&P 500 has broken above its 200-day moving average and is starting to squeeze a little bit higher still. So let's get into the charts. The first chart that I'm taking a look at is the daily chart of the S&P 500. And what you can see here is that the market was broadly range bound for a couple of weeks in early May between about 2,800 and 2,950. Last week, it broke to the upside above that range and then pushed up towards the 200-day moving average, which is at 3,000. It then broke above that 200-day moving average in the last couple of days. And as I sit here right now, the S&P futures are trading at about 3080. So pushing up towards the upper target. There is a higher target there, the range sitting at about 3,100. And that's, you take the range, the recent range of 2,800 to 2,950, and you project that distance up, and that gives you your range target. So 3,100 is what we're looking at there as a possible near-term target based on that range breakout. But certainly all the moving averages here are looking fairly bullish at the moment. We've got the 50-day moving average pointing up. The price is above the 15-day exponential moving average, and then obviously, as I mentioned, above the 200-day moving average now. So certainly surprising many of the bears with this move to the upside. If we move on to the next chart, this is an hourly chart of the S&P 500. And here you can see more clearly the big range that I spoke about between 2,800 and 2,950. The market initially made a false breakdown below the bottom of that range, but then the move back up into the range probably should have been a clue that it would then break to the upside. And it did. It pushed out through 2,950. And you can see that there's quite a nice, clear step-like pattern to the trading action here over the last couple of days. So the levels that we've been monitoring closely are 2,980, 3020 and 3070. And as I said, the futures right now are pointing to a move above 3070, and we're looking at that 3,100 target coming into play fairly soon. The next chart then is an interesting one, and it just talks a little bit to the breadth in the market, because there's been a lot of commentary out there that the market breadth hasn't been that great, and that this rally in the S&P 500 has mainly been led by the tech stocks and a couple of very large heavyweight stocks, and that the breadth hasn't been all that good. But this is an interesting chart. What it does is it looks at the percentage of S&P 500 stocks that are above their 50-day moving average, and you can see in the beginning of this year that was almost down at zero when the market crashed, but now it's moved up to a position where 96% of the stocks are above the 50-day moving average, and that is actually a new high for this millennium. So remarkable to see the significant turnaround in this indicator, and how quickly that has happened from a situation where literally almost none of the stocks were above their 50-day moving average, and now almost all of them are above their 50-day moving average in such a short space of time. The final chart that I've got to look at here shows the historical pattern of the S&P 500 and the VIX, and this is from topdowncharts.com. And look, this year's by no means been a normal year, so let's first of all get that out of the way. But if one looks at this, the black line there shows the typical average historical performance of the S&P 500 throughout many years, going back over the last about 30 years or so. And what it really shows you is that these middle months of the year, the northern hemisphere summertime, typically sees a fairly range bound market, a little bit of volatility picking up, as you can see from the VIX in the bottom there. As we go through July, August, September, and into October, the volatility tends to pick up, but the market tends to be range bound and but directionless. So do keep that in mind as we head into these middle months of the year now, that is historically the pattern that we've seen. That's all I've got for you this week. I'll be back again next week with a look at the S&P 500 again, and possibly some ETFs.